good to see everyone. Listen, I want to dive right in. We got a lot to talk about. First of all, thank you for allowing me your time. I know that everybody's time is very valuable. We're going to talk about spread trading today. Spread trading is one of my favorite ways to trade. And I think it's a phenomenal way for newer traders to trade. The reason why, but all sorts of traders, the reason why is because one of the biggest attributes to your success long-term as a trader is to get wins. That sounds obvious, but it's not all about winning when it's all said and done long-term. But early on in your career, you have to build the faith. You have to build the faith in what you're doing. And I ask students all the time, what is the main thing that they want to do? And the main thing that most students and most traders want to do is they want to get to a point where they're independent, right? They don't want to have to depend on me or anybody else. They want to get to a point where they can do this themselves. And that's really my goal. But you got to convince yourself of two things first and foremost. And those two things is this. And this is going to sound fairly obvious at first, but I want everybody to type it a yes and kind of participate. We're going to go through some charts. I actually have 3 very solid trades that I'm setting up for next week that I will share with you today. You guys are going to walk away with actual trade alerts and setups for today. But number one, and I just want to make sure everybody's kind of on the same page. This is going to sound kind of obvious, but it's very important. Number one, is somebody making money in the markets right now? Now, I know the markets are closed, but with crypto, pretty much we can make money all the time. But is something, whether it's you or not, is somebody making money in the markets? Yes or no? And I know that sounds obvious, guys, right? You're like, well, yes, Tyson. I wouldn't be here if that's not the case, right? Okay, awesome. So these are the things that I used to write down, or I wrote down when I was first learning how to trade with my mentor. He said, Tyson, you have to remind yourself every single day that somebody's making money. You're going to go through some hard times. You're going to go through some drawdowns. You're going to go through some equity highs and all that, but you got to remind yourself somebody. So, and that's important because this is a duplicatable formula. What I mean is if somebody else is making money, there's somebody that has your guys's background and a similar worldview and maybe grew up in a similar economic, circumstance as you did, and they've made it in this business. And that's awesome because, when I was young, I wanted to be, I thought I was going to be a professional football player. I'm a big Raiders fan. I was like, I'm going to play for the Raiders. My problem is I went through a growth spurt and I stopped growing at about a sophomore in high school, and everybody else caught up to me. So my dreams of playing the NFL were gone. I couldn't lift enough weights or run fast enough or do enough drills to ever make it. So this whole, believe it and achieve it type of thing is not true. Like, I can't play in the NFL. I can't be a Grammy award-winning singer. My mom kind of lied to me, I guess, when she said you could be anything that you want to be. But you can be a professional trader. The difference is this. It's a level playing field. When we go to a chart, which we're going to go to plenty of charts, when we go to a chart, you guys and everybody in the world is looking at the same exact, when they're looking at the SPY as an example, we're all looking at the same price. We might be looking at different time frames or different bars or different indicators, but it's a level playing field. And the thing that we need to always remind ourselves is, yes, somebody's making money. Great. But number two, this is a transferable skill. And I wake up every single day knowing I can generate income for me and my family, which is really, really important. And also, if somebody else is doing it, and this is one of those businesses where we really can. Like, I can't be Elon Musk. I can't go to Mars. I'm not sure if he can either, but I know I can't. And so if that's the case, I know that if somebody has a pattern or somebody has processes or formulas that they use to generate income consistently, then I can do that. I just need to know what they're doing. Now, they might do it on millions and millions of dollars, and I might only have to start with a smaller amount, but that's the only difference, guys, is the amount of capital we're starting with. But that's also a really important thing that you need to understand is preserving capital. You must get wins early, and you must preserve the capital that you have. Those are the two biggest things that my mentor taught me, because if I get wins early, my faith in this business grows. If my faith in this business grows, then what happens is it's kind of that success begets success type of attribute. that kind of compounds on itself. Now, you can't get this, invincible type of mentality of thinking you're never going to lose, because losses do happen, but we need to help you get wins. So that's going to be the focus today. How do we help you get high probability wins with taking smaller risk and being able to still make a substantial amount of money? So my whole goal when I trade is to do these things. And I want to just know if you guys are like, okay, yeah, that sounds kind of cool. Number one is I want to risk less to make more. Yes or no? Again, these are obvious questions, right? Let's hypothetically say I have a $10,000 account. I could buy $10,000 worth of some stock or some option or some Forex, whatever it might be. Or what if I could, and let's say that $10,000 investment has the ability to make me $1,000, let's hypothetically say. Well, what if I could, instead of risking the $10,000, what if I could risk $500 and still make $1,000? Obviously, that's the goal. That would be awesome. So risk less, make more. But here's my biggest frustration with where we're at in the market right now. And I'm sure some of you guys and gals would agree with this. We are living in a world of so many so-called market guru geniuses that are just amazing. Oh man, you go on YouTube and you see, wow, there's so many people who are amazing at trading. And I question that, because I know that I've seen this before. In fact, I've seen this in 2006 and 2007. There was a bunch of really, really bull market geniuses out there that knew what they were doing and could never lose. And they promoted these, oh, look at this amazing track record. And all of a sudden in 2008, they went away. How many of you agree that there's a lot of people out there acting as if they're bull market geniuses, or let's just call them gurus out there that think they know what they're doing? And listen, a lot of these people are making money. But they're making money in one of the easiest environments, and we've kind of shifted. The environment has not become so easy. It hasn't, over the course of the last couple of months, the environment has changed a little bit. And we're going to talk about that. We're going to talk about how we change with the market flows. We can't, we can't just make money in an up market. Now, I'll tell you this. If you have never traded before and you're like, hey, I want to trade, even if you've traded a long time, I'm going to give you a little bit of a hint. Best thing you can do is be more of a buyer than a seller. Now, you've probably heard the statement of, the bulls climb stairs and the bears fall out windows. And that's true. The bulls, you can even see it in the S&P 500 chart here. I mean, obviously this was a big rally, but you see it's kind of stair-stepped high, and then bam, when it starts to fall, boom, it falls big. So there's a lot of money to be made on the downside, but we have decades, centuries worth of history telling us that markets go up. And I'm a probability trader. So if I have centuries worth of time telling me that the markets historically more often than not go up, then I need to, for the most part, position myself more bullish on an aggregate basis. That means probably 60, 70% of the time, I'm going to be more of a bull than I am a bear. But I need to know when to switch to bearishness. How many of you agree with that? So the key is to also be able to make money on the downside, but we need to know when to either one, get conservative and preserve cash, or two, maybe even take some shots on the downside. But we can't be I've known some really good traders that have lost a small fortune trying to pick tops, thinking that the next crash is around the corner. And they're eventually going to be right. Eventually they're going to, eventually these markets are going to fall, but when? How much premium do you have to, blow through before the market actually turns? So we want to risk less to make more, and we want to do that up, down, or sideways. And that's so important, guys. I cannot have a trader of mine that learns how to trade and invest with me only make money in an up market. Because you could do well. What happens when that changes? We can't only make money in a down market. And there's a lot of traders out there, a lot of people. My father-in-law is an example. He left so much money on the table because he's somebody who's like, in 2008, 2009, he went to cash. And he sat in cash because he was concerned. He sat in cash for about 4 years. So he missed a huge chunk of the rally. And now he had to work another 5 to 6 years because he missed out on the massive growth in the stock market. So we can't be too conservative either. There's got to be a right mix of taking shots making sure that we're not risking too much, but also able to generate the income that we all need for our families. And so the way that I do this, guys, is I think, and I'm going to talk, you guys mind if I talk about some ugliness in this business? Type it a yes if you're okay. Listen, I try to be as well, I don't try. I am as real as they get. Anybody who knows me would second that, but I'm going to tell you right now, I am who I am. So here's the ugliness, guys. You guys are in a business or venturing into a business. Maybe you've been in a business for a long time, or in this business for a long time, but here's the ugly reality. About 90% of the people who try to do this, especially on an active basis, either lose money or substantially underperform the market. That sucks. That's frustrating. And the reason why that sucks and that's frustrating is because I love this business. The other reason is because I believe that the people who try to do this, you guys, whether you've done this for a long time or not, I think the fact that you're in this webinar, you're listening to me and you're learning from all these great speakers, you have what I call the trader seed. So I'll use me as an example. For 3.5 years, I've been trading for over 20 years. And by the way, this is me here. I've been trading for over 20 years. I would love to tell you that those 20 years were like, oh man, rainbows and butterflies and everything was amazing. It wasn't. 3.5 years, guys, I was probably the world's lousiest trader. I made every mistake you could ever make. I hid money from my wife. I lost about $350,000. It seemed like every trade that I took was a loser. And I'm a man of faith. And what happened was I spent time like on my knees, shouting out to the Lord saying, listen, take this away from me because I suck. I don't want to have to do this anymore. I don't want to have a desire to do this because I can't do it. But here's what happened. My desire to do this, even though I would maybe wake up the next day or the next week because I lost a bunch of money, I try to fool myself that I'm not going to do it again. It never went away. How many of you would agree that the desire to do this, and that desire, I believe, is like an innate God-given desire, and it's the desire built upon one word, guys, freedom. Your desire for freedom. Yes or no? Yes or no? We've got a lot of people in here. I want to know how many of you agree that's the core. It's the freedom to do what we want, when we want, how we want, when we want. And we know that in the world we live in right now, that means we need to generate income and we need to make more money with the money we have. And so the sad part about the 90% stat that lose money is that the people that those 90%, when they lose money today or tomorrow or last week or last month, they don't wake up the next day saying, oh, well, I'm never going to do that again. No, they don't. They wake up and they might fool themselves that they're never going to do that again. They might fool themselves that they're never going to try to trade, but they're still going to want to do it because that core desire of freedom is still there. So here's the deal. I look at that stat and I say, okay, well, that's sad and that's not good. But it's also, on the flip side, it's also encouraging because I am convinced that this business is a duplicatable format. I am 100% convinced of that. And that means that I don't care if the numbers was 99% lose money and 1% win. If there's one person doing it, why not me? I just need to find out what that person is doing and then duplicate what they do. And then over time, I make it my own. Yes or no, guys? Isn't that the reality of this business? Let's find out what the winners do. And then let's just do what the winners do. And my goal for all of you in this room is for you guys to attach yourself to a winner, whether it's me or somebody else in this room, whatever it might be, but attach yourself. And then over time, start to do what they do. And then over time, you're going to formulate your own little tweaks to that strategy, your own little concepts, your own little scans, your own little ideas, and it becomes your own. That's when you gain that freedom, which is huge. So we just need to find, but okay, so everybody agrees like, yes, oh man, Tyson, all we got to do is what the winners do. You're right. But who are the winners? And this is going to be the key of what we're going to talk about today. The winners oftentimes are the biggest, and in fact, they're the biggest players in the markets. They're the market makers. They're the floor traders. They're the hedge funds. They're the ones that actually control more market and order flow. Type in a yes if you agree with that. They're the ones that control. They have, it's almost not a level playing field when it comes to them because they have the ability to do things that you and I maybe don't have. they can get into positions and hold on to losers for long periods of time because eventually, here's the deal, they're not afraid to hold on to losers because they know they control ultimately the order flow. That happens a lot of times in Forex. I'm also a very astute and professional Forex trader. I trade Forex every day, all day with a bunch of students. And it happens oftentimes in currencies where these big, large players will hold on to positions for long times because they're not afraid to go through drawdowns because they are the market. But what we got to do, if we know that, if the professionals out there, the 10% out there are making money because they really control the market, what do they do to make the most amount of money? What does the professional traders, let's talk about options. That's really what we're going to dive into. The professional options trader, and all professionals understand the elements of options because they use options to either hedge their risk or underwrite risk within the markets. What I mean is this: the professionals out there understand that the average person loses money when they try to do this. The reason the average person loses money when they try to do this is because they get caught into this fear and greed cycle. Yes or no? It's a fear and greed cycle that they get caught into. And it's just like Warren Buffett. What company has Warren Buffett made the most amount of money on? Obviously railroads and different things like that. But one of his most profitable, one of his best purchases ever is Geico, is an insurance company because he insures people's fear and greed. It's the same thing in the markets, my friends. It just is. So if the market makers are insuring fear and greed, why are you and I not insuring fear and greed? Here's to say it another way. If we have 9 traders out of 10 and we know the 9 that are going to lose, how many of you would agree that we just have to do the opposite of what the 9 do? You guys agree with that? Find out what the 9 are doing, and let's just do the opposite. Now, the 9 might be lucky this week. The 9 don't always lose money, but over time they lose money. So let's just do the opposite of what they're doing. That's it. And so we got to figure out what the opposite of what they're doing is. Well, it's accepting returns that are stable. It's not accepting a reality or a lie that, hey, I can just buy an at the money call option and the thing's gonna return me 1,200% in the next 4 weeks, and that's just the way it works. No, that's not the way it works. 98% of all options expire worthless. So obviously that's not the way it works. Those people that are buying high premium options, most of those people are losing money. Just a little hint. They just are. And so what do we need to do? We need to be an underwriter of the market. But how do we do it? What do we do? So I'm going to teach you guys a little bit of a lesson today that I think will go a long ways. Also, at the end of this, I'm going to give you guys our it's called Equities on Demand Spread Trading Cheat Sheet. It goes through all of our types of spreads, the bull put spreads, bear call spreads, straddles, strangles, how we play these on earnings plays, different things like that. You guys are going to be able to get this. I'm going to give you guys a link here in a little bit. Actually, I'll share it with you. I'll share this a couple times throughout this presentation, but I'll share this link with you right there. So when we're done, this is free. You guys will get this spread trading. It's actually really in depth. It's great. Goes through all our different spreads. But here's the concept. Here's the key concept. We need to trade like a market maker. And I want you guys to really write that down and make this your goal. And the reason why I want you to trade like the market makers is because the market makers make money, the floor traders, right? Floor traders. And who are the floor? They're the bank traders. They're Goldman Sachs, Morgan Stanley, Bank of America. They're the ones on the floor controlling the order flow and risk. So what they do on the SPY, as an example, and again, I'm going to give you 3 live trades before we're done. What they do is they look and they say, okay, the S&P 500 exchange traded fund, the SPY, last week it closed at this price right here, and I'm just going to mark it. It closed at 416. Let me just mark this here real quick. 416. The close was 416.49. So I'm going to mark that level. 416.49 was the close. Now, here's one thing that might kind of shock you. Floor traders, market makers, bank traders don't necessarily put a huge value on technicals. Now, you and I do. You and I, and we should. we should put a big value on technicals, because the way that you and I can get an edge is to get a technical edge. Yeah, we can get a fundamental edge also, but we need a technical edge, because just based on probability, let's just do a quick test. Based on probability, let's take technicals outside of the equation. Let's take historical responses of the market typically rallying up out of the equation on a tick by tick basis. As of right now, isn't there a 50% probability price goes up and a 50% probability price goes down? Just based upon statistical analysis. Type it a yes if you agree. Guys, that's it. Again, let's take out, I know some of you are like, well, no, because we have a historical bullish, centuries. You said it, Tyson, centuries worth of, you're right. And, tying in technicals, there's maybe a bias to one side, but on a tick by tick basis, it's a 50-50 proposition. And the market makers know that. And they know the easiest way to trade is to not necessarily define some type of aggressive directional bias, but it's to understand the ranges that something should stay within. Because they know that somebody in the world is going to come into the market and be super aggressively bullish next week. Somebody else is going to come into the market and be super aggressively bearish next week. And you know what? There's a 50-50 proposition, or 50-50 odds that, one of those people, obviously the bull side might win or the bear side might win. But if price closed at 416.49, what the market makers want to know is how high historically should price move? And there's something called maximum pain. And I'm not going to go into a ton of details on what maximum pain is now, but essentially it means what is the price that market makers want the week to end where they don't have to walk home or go home with any open positions. Little bit of a kind of a shocker for you guys, but market makers, floor traders, they don't want to go on the weekend. They don't want to hold any longer short positions. They want to be flat for the weekend. Interesting. Because what they want to do is they want to underwrite somebody's greed. They want to underwrite somebody's fear. They want to be the State Farm insurance agent to the market. And that's what you and I should want to be. But how do we do it? Well, one of the simple ways to do it is to understand kind of the market maker levels, where they're going to start to defend price. I'm just going to give you kind of a rough estimate or rough idea of how this works. Now, we use at Market Traders Institute, Equities on Demand, we use what's called a blended average true range. So this is a portion of what we use, but I'm just going to show you in this example of one. Right here, we got a 5-week ATR. An ATR, for maybe some of you that don't know, the ATR is just essentially an average true range. It basically means over the course of the last 5 weeks, how much does price typically move from high to low? So what ATR doesn't know is it has no clue. So you guys see this? How many of you? Yeah, I want to make sure you guys see this. $9.77. So ATR equals 9.77. Okay. But here's the deal with ATR. ATR has no clue what direction that $9.77 is going to come in. It doesn't know if it's up or down. In fact, if we go back historically, we can see that when the market moves, and I'm going to encapsulate some weeks here, when the market moves, we can see that sometimes it moves most of that movement on the upside, but sometimes it's a little bit on the downside, it's a little bit on the upside, a little bit on the upside, a little bit on the downside. It's very rarely all in one direction, and the market makers aren't going to expect all of that to come in one direction. So if we expected all of that in one direction, then you and I would say, okay, well, price closed at 416.49. Whoops, 416.49, and we have a $9.70 or $9.77 ATR. We would expect price to go to 426.26. So I'm going to mark 426.26. 426.26. And there's somebody out there that thinks that the S&P 500 next week is going to go to 426.76. And maybe it will. I have no clue if it's going to or not. I can tell you, technically speaking, probably not. And I'll explain why here in a minute. But somebody believes it's going to go, oh man, it's going to, somebody's getting really, really, really bullish. They believe this thing's going to rally up next week up here. And man, they're willing to buy at the money options next week. And oh, it's going to be great. Maybe it will. Maybe it won't. Somebody else is going to come into the market and say, hey, you know what? Price closed at $16.49. And, you know, I believe price is going to fall, and price might fall down to $9.77, because that's the average distance price moves is $9.77 based upon the average high to low of the last 5 weeks. So we might fall to 406.72. So I'm going to mark 406.72. So that's kind of the what's known as kind of the maximum movement expected. Now the price obviously can move more than that, but 406.72 is kind of the maximum movement of expectation for next week. So again, somebody in the market is going to come in and be super bearish. And they're going to say, man, these options, they're going to fall. The market's going to tank down, and I'm going to bet. And they think it's going all the way down here. Maybe it is. Maybe it is. But you and I don't know. The market can do whatever the market wants to do. The market makers know that the market can do whatever the market wants to do. So it could rally up, and it could fall down. But here's what the market makers say. I have no clue. And this is going to shock some of you. The market makers, the most professional traders in the world, have no clue on a week-by-week basis what the market's going to do. But what they do know, with almost probably about a 90% certainty, is they know it's going to stay within a range. It's going to stay within a range. What range is it going to stay within? They have no clue if all this $9.77 is going to come on the upside, or is the $9.77 going to come on the downside? They don't know. So what they do is they say, you know what? It's probability says that all of that's not going to come on the upside. Probability says that all of that's not going to come on the downside. What's most likely to happen is we're going to get half of it on the upside, half of it on the downside. Type it a yes if that makes sense. That's probability. That's essentially what they say. And then if we get the move, here's the deal. If we get the move up, halfway up, let's say price then early on in the week goes and moves up halfway up to here. Here's what happens. And you're going to see this. I'm going to show you time and time and time again that this is the truth. Market makers have a decision to make at that time, because what they are doing is they are coming in and saying price should not close above the week, should not close above that level there. So that is the level that they're going to underwrite insurance at. They're going to do what's called bear call spreads. They're going to sell calls around that level, because that is the expected high for the week. Now, here's the decision they have. When price, or if price rallies up to that level, if price then starts to break that level, they have to, you'll oftentimes see price break. And if it sustains above that level, they then have to start to come in and aggressively buy, because now they have to hedge their positions, because if they don't come in and aggressively buy, they're going to be exercised, and they're going to have to basically short those shares by the end of the week. So what happens is this is a decision point. And around this area, they have to they're going to sit on their trades and they're going to hold. Price is going to base around this area, and it's going to make a decision on the upside or make a decision on the downside. Most of the time, because they already have the position in, most of the time, the market makers will come in and they will start to short the stock at or near this level, because that is the price they must have price get down from, so they get themselves out of trouble. Type it a yes if this is making a little bit of sense. That's the area where, as long as price is below that, they get to go home over the weekend. They get to have a barbecue with their families and be like, oh man, I made a bunch of money by underwriting somebody's greed or fear. Now, that doesn't always happen. Sometimes it breaks. And when it breaks, they're not all that concerned. What they'll do is they'll hold their short calls, but they'll start to hedge by buying the shares. And they'll start to minimize their risk. But oftentimes, guys, more often than not, in fact, probably about 80% of the time, price will fall by the end of the week within this range. Now, price could, at the middle of the week, price could have rallied up aggressively and be way above that. For example, last week, the expected downside low was right about here last week. You see how price fell down. It based around this level for a little bit, flushed out, and then the market maker said, you know what? I don't want to hold these shares long. They then rallied price to get themselves out of trouble for the weekend. That's exactly what happened. I'm going to show you many examples of this. So here's the deal. They don't know if that ATR is going to, all of that ATR is going to happen on the upside or the downside, nor do they care. What they care about is the levels that they want to defend. What they want to say is they say, you know what? Price, historically, probability says price is going to stay above that level. And historically, price is going to stay below that level. So right here, I want to start defending price if price gets down there, right there. I want to start looking to sell price if price gets up there. That's what I want to do. But here's the deal. They don't even know if price is going to get to any of those levels. So let's just talk about stats for a second. For price to open up next week and rally up to this level, there's a 50% chance, and it's actually less than 50%, because price could do this. Price could open up and stay within this range and not even go to any of those levels. You guys agree with that? Type it a yes if you agree with that. Like, it's less than 50% because price might not even, we might have an inside week. We might be a really tight week. So it's actually close to like 45% or so that price is even going to hit these levels. But let's just say 50%. Okay, once price hits, let's say price hits this level, and there's a 50% probability of price hitting that level. If price hits that level, what is the chances of it closing above that level by the end of the week? And that's a hard, kind of a hard stat to understand, because it depends on how early it happens. If it happens on a Monday, obviously maybe the probability is a little bit higher, but if it happens on a Thursday, it's a little bit lower. On an aggregate, the median percentage of it closing, if price rallies above or rallies to this level, you know what the probability of it closing above that level is? 50%. Type it a yes if you understand that. Because we're talking about an aggregate price. At any given time, there's a 50% chance it closes below, 50% chance it closes above the current price. And that's not even taking into account that, well, there's a probability that it actually closes right at the level. So if there's only if we're talking about 100 times, let's say you and I take this trade 100 times, and I'm going to go through the details of the trade in a second here. But if you and I, let's say we structured bearish trades, right here. We said, you know what? Price is not going to go above, and I'm going to get the exact numbers here. I don't want to be. So 977 divided by 2 plus 416.49. The expected upside high this week is 421.37. So I'm going to put 421.37. So let's say that you and I structured a bearish trade, and we said price is not. So what we're saying is price is not going to close above 421.37 at the end of next week. That's essentially what we're saying. What is the probability what is the confidence level you and I should have if we put a trade on next week, let's say on Monday? What is the confidence level that you and I should have that price will close below that level? Well, let's just use easy stats. We already concluded that there's only, out of 100 trades, let's say 100 times, 100 times, 50 of those times the price will be hit, right? So that means the other 50 times, the price isn't going to even hit that. So we automatically know that we're going to win. Price is going to be below this level at least 50 times. Yes or no? At least 50 times of the 100, we know that, okay, it's not even going to hit that level. Price is just going to tank down, and we're not in trouble at all. I mean, everything's good. Okay. But so the 50 times it doesn't hit the level, we're not concerned with. What we're concerned with is the 50 times it does. So then again, I ask, out of the 50 times it hits, so 50 times it hits, what is out of those 50, how many times does it close above and how many times does it close below? We've already said it, right? 50% of the time. So 25 times it closes above. So if I take a trade at the beginning of the week, and I know that automatically I have a probability of, let's say I took this trade 100 times, 75 times out of 100, we're going to close below this level. 25 times, and this isn't even including technicals, guys. 75 times out of 100, we're going to close below this level. The other 25 times, we're going to close above. Type it a yes if you automatically see that you now have an edge. You now have a probability in your favor. You now know really important information to say, you know what? Maybe I can establish a trade right away on Monday. Or how about this? What happens if and when price comes up to this level? Well, I'm going to tell you guys right now, just based upon what I've taught you so far, if price hits this level, look to structure more bearish trades. If price hits this downside level, look to structure more bullish trades. And Merle says something really important. If you can combine that, Merle says support and resistance. Yes, Merle, absolutely. If you can combine those market maker levels with an area of supply or demand or an area of support or resistance or a Fibonacci extension, holy smokes, guys, you have a eureka moment. I just want to pause and just ask, how many of you are following along so far? So these are the market maker levels. Let me get the exacts to the downside. 416, 49. Let me do that again. 977. Type in a yes if you guys are following along. I just want to make sure everybody's following. This is really important stuff. 416.49. All right, our expected downside is 411.60. Okay, perfect. So what we got here, without even tying in any technicals, and that's the nice thing is, guys, without even bringing in technicals yet, we know next week, guess what? You have an area, S&P 500 gets down here, start to look to structure more bullish trades. I'm not saying buy right away, but start to look to more structure, because oftentimes, more often than not, that's an area that you know the institutional traders will have to rally price and get it someplace in here before the end of the week. Okay, that's huge. It's huge. And if you can combine that with some technicals, even great. Same thing up here. When price gets up here next week, look to structure more bearish trades. Here's the problem, though. Here's the issue. We might not get up to that level. We might not get down to that level. And I don't know about you, but I like trading. I'm not a fan of cash. And I don't want you guys to get sucked into this mentality of, oh, man, well, a trader has to trade. It doesn't have to. No. Sometimes cash is a position, but whenever we're in cash, especially now, I mean, look at inflation. It's going nuts. That's a losing asset. So if price doesn't go up to those levels where I can start to structure sell positions, or down to those levels where I can start to structure buy positions, then I'm just sitting in cash all week long and doing nothing. Well, that's not fun. So what can I do? Are there trades that I could structure to be truly like a market? Because the market makers really don't even know. They don't know if it's going to go up there or down there, but they want to make money every week. They don't want to go buy 1 week and say, well, I'm only going to trade if it hits this level, because they don't know if it's going to hit that level. So they want to structure trades right away. And that's why they go out and they do spreads around those levels. So they look to generate income. So before I get into this, I just want everybody to know that this is the main stat. We have a 75% chance, minimum. This is not even including technical, 75% chance of price closing below this level next week. That's the main concept that I want to drive home right now. On the opposite side, we have a 75% chance of price closing above this level next week. Again, I know I've asked this a lot, but I just want to make sure. Does that make sense? That's the core concept so far. Okay, perfect. Now that right there has automatically given you guys a high. So remember the first goal. The first goal is to get wins. If you guys win, 75% of your trades, that helps you get some wins under your belt and grows your faith, grows your confidence. So again, you guys could set a limit order to start to look to sell. I don't care if you buy, at the money puts here, or you sell the stock, whatever, you do the same thing down here. That's great. But let's be a little bit better. Let's be the underwriter. Let's be the Warren Buffett of the stock market. Let's do what the market makers do, because they have to make money every week. So what they do is they say, okay, you know what? Let's structure spread trades around these levels. And the market makers will do both sides. So they'll do what's called an iron condor, and they'll do what's called a bull put spread down here, and they'll do a bear call spread up here. They'll collect a minimum amount of premium that they're willing to accept, and then they'll essentially say, okay, depending on how market moves, if the market moves down and I have to start adjusting my bull put spread, I will. If the market moves up and I have to start adjusting my bear call spread, I will. And that's what they'll do. But the issue with that is that that's time consuming, and it requires you to be a really astute full-time trader that's in front of your screen, so you can do those adjustments. And that's all. That's good. That's good and great. So each week we could just sit here and say, okay, let's do what's called an iron condor. Let's find the market maker moves. Let's do bull put spreads down here, bear call spreads up here. If and when one of those levels are hit, we'll start to do our adjustments if we need to. And at the end of every week, 80% of the time, 85% of the time, we should generate some nice income. That's not what I want to do, though, because you and I, we can be better than that. We can be better than that. And the reason we can be better than that is because of technicals. So if we have the right technical parameters, then what we can do is we can say, you know what, price, if we knew that price had more of a probability of hitting this downside here, then why would we want to take a trade that says, hey, we need price? I don't want to take a trade that's trying to defend this level then if I think that that level is going to be hit. I would rather, if I believe that price has a higher probability next week of hitting this level, why not only focus on that level right there? True or not? You guys agree? Let's only focus on the level that's actually going to be defended. So the question I ask myself every single week is, what level am I confident price is either on the bear side? What level is price not going to be above by the end of the week? Or what level is price not going to be below by the end of the week? Period. And I already know those levels. Price should not be above or below this level or above this level. But if we use technicals, we can make it even better. So now we already know we have a 75% chance of it being below this level or above this level. I'm not interested in the downside level, though, for next week, guys. I'm just not. I'm not interested in that level. Why? Because of the technicals. Because of what's happening. So you guys see this blue area right here, this blue area. This is called our power play zone. All right, and you guys are going to have the ability to get this in your hands if you'd like. This is called the power play zone. In the power play zone, price often will stay within the power play zone, but when certain patterns play out and we start to get above the power play zone with a combination of what's called supply levels, then you know what? We don't want to be super aggressively bullish. Essentially, what I'm saying is we have something called, I'm not sure if you guys have ever heard, you've heard of head and shoulders patterns, I'm sure. Well, we like to focus on things that are called crowning formations. And crowning formations are very powerful because a crown formation shows that price structure has already broke. A head and shoulders pattern is this. Let me show you a head and shoulders. Head and shoulders pattern is essentially where price would kind of stop at the neckline and then rally up and create a right shoulder and then fall. Whereas a crown, and you'll notice the difference, a crowning formation is one that has already broke structure. It broke structure right there. Type in a yes, and then it comes back up. Test that structure. Type in a yes if you see what I'm talking about. So we have a bear crown setting up. We've broken structure. Trend analysis 101 is higher highs, higher lows is an uptrend. Lower highs, lower lows is a downtrend. Have we started and shifted into a potential lower low, lower high environment? Yes, we have. On top of that, look at where our market maker level, our expected defended level is at 421.37. It's right at what's called the supply level. So we have a supply level at the market maker expected high next week with a bear crown formation happening right in front of us. This is a phenomenal trade. So this trade right here, if I did what's called a bear call spread, so here's the trade. If I went out, go out to next Friday's expiration, which is the 521 options, look to sell. So in this example, you would sell the strike, the call that is one strike above my line in the sand. So I call this level the market maker line in the sand. And that's the level that the market makers are going to most likely start to step in and defend price at that level, because that's where they're going to have to make a decision. So if I sell an option, the May 21st option at one strike above that level, that is going to be the one or the 422 call. At the same time, so if I just sell, so if I wanted to, so market makers will oftentimes, they won't even spread their trades. What they'll do is they'll just do naked calls because they have unlimited amounts of money, right? They have a ton of money. But you and I don't have a ton of money, right? You and I don't have tens of millions or hundreds of millions of dollars. So instead of us going in and doing a naked call, which a lot of brokers won't even allow you to do, and if you did, this trade would require at least $42,000 worth of margin to do, right? Which I wouldn't recommend anybody doing. Instead of doing that, why not spread it? So you're going to look to sell the 422 because that's above the market maker zone. The market maker level, that price should stay below. And then buy, look to buy at the same time, buy the 423. So you create what's called a $1 bear call spread. And what that does is instead of using $42,000 of margin, this trade costs you $100 of margin. So now anybody with an account of $100, $500, $1,000, any type of any size of account for the most part could take this trade. If I do a 422 by 423 bear call spread, why would I do that trade? Why do I like that trade? Because that's the level that market makers are going to defend. So one, we got probability, we got 75% probability in our favor. Two, we're sitting at a level of supply. And three, we've got a bear crown position or bear crown formation happening right now. I need everybody in the room. Yes or no? Is this starting to click on why this is an example of an absolute phenomenal trade? This is a jackpot, guys. Now, doesn't mean we're going to make money on it because we don't make money every single week. But we make money way more. In fact, we only make money about 75, 80, 85% of the time. However, that's okay. I'm all right with losing 10, 15, 20% of the time because I know the wins well outweigh the losses. And all I've got to do, it's just like flipping a quarter, guys. If I know I have a quarter that's been rigged to pay me more often, I just got to flip that quarter more often. So here's the deal. This is actually a trade that I love that I'm going to be placing next week with the group of traders. I'm going to go out to next Friday, the May 21st options. I'm going to sell the 422 and I'm going to buy the 423. Now, here's the key. Here's the key, guys. This is the biggest key to it all. And Stu asked the question, how large are your wins versus your losses? So this is a little counterintuitive. I want you guys to understand this. When you're taking these type of trades, you cannot over leverage, okay? The reason you cannot over leverage is because initial risk versus reward isn't as great as I would love it. I'm looking to make a minimum. I have to control the amount of money that I make in this. And probability says the only way I can take this trade is to do this. I will accept only a minimum of 30 cents credit. Period. I will not sway on that. If I'm unable to get into this trade and the market doesn't pay me 30 cents of credit, I won't take the trade. Now, you might be wondering why. Because let's say that something crazy happens in my life and I don't have time to manage my trade. So when price goes up and hits this level here, I'll manage my trade, okay? That's what I'll do. But let's say that you're a trader like Tyson. I don't have time to manage my trades that much, right? So I'm not in front of my screens a lot. So what if I just take the trades and I kind of forget about it? Is this a winning trade? Well, think about this. Well, first of all, remember this level here, we have a 75% chance of price closing below that level. And if price closes below that level, we make 30 bucks. So price closes below that level, we make $30. But wait a minute, Tyson, what if it closes above? Now, this is actually not a fair assessment, but if price closes above, we have $70 at risk. Oh, that sucks. Tyson, $70 risk, $30 reward. You're right. You're right. That's not great. But wait a minute. Remember, we truly have, not a guess, but truly have a 75% probability of success without even tying in the technicals, which probably gives us another 5 or 10%. So that means that if we take this trade 100 times, 75 times, we're going to make that $30. Yes or no? Just based upon the historical stat, just based upon the historical probabilities. That means we take the trade 100 times. On our wins, we make $2,250. $2,250. However, and this isn't even fair, guys, because all of your losses are not fully going to be $70. They won't be $70 every time. I'm going to show you guys will learn how to manage these trades over time. But let's just say that, oh man, we're like the worst traders ever. And yep, we win 75% of the time, we get the 30 bucks. But the other loss is we just lose everything. We lose all $70 the other 25 times. So the 25 times we lose 70 bucks. Well, that means on our losses, we lose $1,750. So wait a minute. if I take this trade 100 times and I win 2250 and I lose 1750, that's not even including the technicals. That's not even including the fact that we're not going to lose the full $70 every time. I net $500 of profit. So let me ask, just based upon getting a minimum credit of $30 or 30 cents on this trade, is this a trade that you and I should take every single time? Yes or no? And then how do we take that $500 of net profit on this trade and turn it into much higher than that? That's when we tie in the technicals. That's when we tie in the management once these levels are hit. That's when we go from winning at 75% to winning at 85%. So what if we could win at 85% instead, and our average loss isn't $70, so we win 85% of these trades. So 85 times 30, 85 times 30, so that's 2,550. Now we lose 15 times, but our average loss isn't $70. What if we could manage this where our average loss is only $40? So now let's take $40 times 15. We're losing. Now this is where, guys, we can make $2,550 and our losses are $600. Now we have a net profit of $1,950. Ooh. Now the question needs to be this. Okay, well, what size of an account do I need to take these trades? Guys, I could take these trades every single month, every single week, every single month, every single year. And I could probably, we're not going to get filled every single week. So this trade offers, there's about 50% of the time we're going to get filled. So there's going to be some weeks we don't get filled. So this is a numbers game. So next week we have 8 plays that we're going to be calling out next week. 8. This is one of them. And so it's a numbers game. But here's the deal. To take this trade, somebody would need, actually only need about $100. But I would say anybody with $1,000 or $2,000, you should easily be able to take this trade because you're risking $70. You're making 30. But overall, if you were able to find these trades every single week, let's say you could find one of these trades every week, and you had $1,000 account, let's just hypothetically say, and you were able to make $1,950 of consistent, reliable income for every $1,000 you had in your account. How many of you would like that? Type it a yes if you would like that. Guys, that's what we do. And here's the greatest part about this. Do I only make money if the market moves down? No. Think about this, guys. This trade, remember my goal, risk less, make more. I'm risking less to make more. I'm trading with the market makers, the fundamental areas where market makers are going to defend. I'm trading with the technicals. And here's the brilliant part, the best part. Price tanks down, I make money. Price goes sideways, I make money. Price could even rally up 1.5%, and I still make money up, down, or sideways. So am I risking less to make more? Am I doing that up, down, or sideways? Yes or no? Guys, I'm going to tell you right now, if you want to be a professional trader, you're listening to the right person. I don't know if you guys know me or not, but you need to know me. Everybody in this room needs to know me, period. That's not, wow, you're kind of arrogant. Well, test me out. I do this with our students, myself and my partner, Chris Pulver. We trade with you guys, with our students every single day of the week, every day for 2 hours live, placing these trades every single day. And what I'm going to do is this. I'm going to give you guys an opportunity. I've shared this link here. And this will be shared out to everybody, but I would love for you guys to just fill out this information. You fill out your name and your email address, and we are going to send you absolutely free. We're going to send you our spread trading cheat sheet. And this cheat sheet is actually really impact. It's amazing. It's got a ton of information on what spreads are, how you set them up, every type of spread you could trade. You guys are going to get this absolutely free as a gift from me today when you sign up on this website. All you got to do is put your name, email address, and we'll send that to you for free. We're not asking for any money right now, guys. Nothing. All I want to know is this. Do you guys want to learn how to trade like a market maker and consistently and reliably make money up, down, or sideways? Yes or no? Yes or no? That's the question. So I said I was going to show you 3 trades. This is one of the trades that I like for next week. Go ahead and take a snapshot of this. There should be a little camera button there. Here's another trade that I like for next week. Disney. Now Disney's different. I'm not doing a bear call spread on Disney. Actually, you know what? Let's go to Starbucks, SBUX. Starbucks. I'm not going to do a bear call spread on Starbucks. I'm going to do a bull put spread on Starbucks. And my area that I believe I'm going to do, or that I'm going to look to do a bull put spread on, is going to be this, guys. I'm going to do a bull put spread at 108 by 107, because that is the market maker level. And by the way, that is an area. Why do you like this, Tyson? Because that is an area where we may go down and test next week, but that should be a bounce area because of the pattern that's happening in the markets. We have supply sitting up here. We might flush down next week to create kind of this neckline, but that should be a bounce area. So 108 to 107 bull put spread, that trade gives us probably about an 85% probability. So now next week, guys, you have a bullish trade in Starbucks and a bearish trade in the S&P 500. You're going to see how you can make money regardless of what the market does. You have trades that give you a high probability of success that generate consistent, reliable income. And I'd love to invite all of you, again, to go out there, sign up for our free spread trading cheat sheet. You're going to get some information from us. My partner and I do this every single week together. We do it every single day. We trade with our students. We do everything in our live accounts. And we make money. We consistently and reliably generate income. And the reason we do that is because this is how we take care of our own families. And our goal, last thing I want to say is this, our goal is to get you guys to the ability where you don't need me or anybody else ever again. That's my whole goal. It's not for you guys to say, oh man, I just got to depend on you forever. Oh yeah, let me put this in the chat section here. Let me put the link. I apologize. Here we go, guys. Yeah, go ahead. And you know what? Do this right now if you can. It just takes a second. Go ahead and put your name, your email address, and we're going to send this spread trading cheat sheet free to you. And you'll also get some information if you want some more information about our power play strategies. If you want to trade with us every single day, I'd love to see all of you guys with us. You give us a week or two, you will be blown away, and we'll prove to you we are the real deal, and we do it live in front of you. So with that being said, listen, it's been awesome. Hopefully you guys enjoyed my presentation. The hour always goes by really fast, and I look forward to all the 10s. No, I joke. But this has been awesome. Thank you, everyone.